question number 10, Tampem company, we have actually taken from your AFM study text. So this question is not from your practice kit. This is from the study text. It's a short question for 45 minutes. And this question, we are going to read it together. But this question actually, it deals with three concepts: APV, NPV, and MIRR. And the reason for picking up this question today is not NPV, because NPV, I mean, the scenario here is not really very complex for NPV calculation. We have done many questions, even more complex questions than this one for NPV. So my focus today is not really on NPV. I'll go through it very fast because we discussed it so many times and we did so many questions in financial management and advanced financial management. My focus here would be on APV, primary focus, where we will spend more time, and reason why do we calculate APV? What is the logic and reason why do we do it, and how do we do it? Because many times students, they do calculate APV, but they don't realize why they are doing it. So how is important, but why is more important? Then MIRR. And the formula, we will try to break down and learn the formula. We know what is MIRR. So it's not very difficult concept, but I would like you to understand that, what is the logic of that formula for MIRR? So I know it is given in exam, it is given in the book, so you will just copy paste or write it down and just put in values. But it would be very interesting to understand the logic behind that formula which they have given us. And if we understand that logic, then we understand what MIRR tells us, okay? So it's more of conceptual lesson than the typical calculations which we do. So we'll start reading the question, okay, together. But before we begin, let me just touch few areas or mention few things which I'm going to discuss, okay? So we've got NPV calculation, and we see that NPV always wins over IRR. Then why do we have APV? Adjusted present value. So this is net present value. This is adjusted present value. So when you already have got this NPV thing, why actually do you need adjusted present value? So what are the issues or the limitations with NPV formula, which, caused us or led us to find out another method? You see, there are two issues. There are two main reasons for using APV method. By the way, APV we do for business valuation also a lot. Okay, so when you do NPV, what you do, that you have your future cash flows, you discount them with your WACC, weighted average cost of capital. So when a new project comes in, and sometimes you use the same WACC, which is actually one of the drawbacks, because when there is a new project, that particular project will bring in its own risks. And when the risk profile or the risk of your investment portfolio changes, you should not be using the same discount rate. So we should be using another discount rate. So what is that another discount rate? And sometimes that other discount rate is not given, or it is hard to find out. So we say that one of the problems with NPV is that we are going to use the same WACC, which was before the project and after the project. Sometimes you cover it through your beta things, but that's a different scenario. You need to make a lot of adjustments. So this is one of the drawbacks in NPV. The second thing is that within NPV, we are using the tax shield. If you have debt, you pay interest, and that interest gives you some tax benefit. And then that tax benefit becomes part of your, ultimate calculation, because you discount it with WACC. So what is happening, that the tax benefit is also discounted at the WACC thing. Whereas your cost of debt might be different than WACC. We know that WACC is higher. Usually WACC is higher than cost of debt. So these are the two issues with NPV. And to resolve these two issues, we concluded, or we resorted to another method, which is called adjusted present value. So how do we do that? In adjusted present value, we say that the company has no debt. We assume that what would be the discount? How would we? So instead of discounting the cash flows on the WACC, which is weighted average cost of capital, which includes the cost of equity and the cost of debt, we say, let's suppose that the business has no debt. Let's suppose if this business is financed, or this project is financed through 100% equity. So we find out cost of equity and we discount it with ungeared. We have this ungeared cost, ungeared, unlevered or ungeared cash flows, we make it. So we exclude the impact of, the risks which are associated with the debt and the cost of debt, we just remove it, okay? So we said that it is a project which is 100% equity financed and it does not have any debt. So what is the value of this business? What is the value of this project in the absence of any debt? This is the first thing. We remove that debt portion. And then after getting it back, the number, the value of the business, then we adjusted that, okay, if I take debt on this project, so this project has a different debt, because you might have different debt sources and offering different, cost of debt. So this particular debt, the project which I'm going to do, I'm going to finance it with 6% or 7% or 8% debt. And then I include or adjust that, impact of that debt financing into it. And then I include or exclude adjust it with the impact of the tax shield into it. So what will happen that you will find out your kind of NPV, or kind of, let's call it the value of this business or the value of this project in the absence of any debt. So you exclude the debt, you say if it had been all equity financed, how much the value of this business would be. But then I know that I am assuming it in the absence of debt, but debt will be there. Absence of debt, I calculate the value. So let's suppose that the absence of debt, the value comes out to be, let's call it, 5 million. But I know that without debt, I cannot get this project because I don't have money. This project needs 20 million. I don't have 20 million. I must be going and getting some debt. So then I add back or subtract whatever the benefit of that debt financing. Okay. And which is my tax benefit and on interest. And then I also discount it on your cost of debt cost, okay, not the WACC. What is the debt? What is the interest rate associated with this debt financing? And the tax shield I will take into account, whatever. And I find out that this is actually tax shield and debt financing is the same thing. So this is the basic idea, okay? So you say that, okay, tear it apart, not discount the cash flows with WACC, discount the cash flows with cost of equity, because it is going to be 100% equity finance project, and then handle the debt separately and make adjustment for that. Okay. There is another thing which is not part of your AFM or any other paper in ACCA, which we say that, this investment appraisal for public sector financing. We have not learned public sector financing in ACCA because ACCA mostly focuses on commercial organizations. But remember that there is a topic, a huge topic, which is called public sector financing, in which you have public sector projects. And those public sector projects, they are not only concerned about the dollar value or, the wealth maximization or the shareholder value, because they do have some other benefits as well. Environmental benefits are there, social benefits are there, which should be included. So, I mean, if you are making, let's suppose, a railway network, and that railway network has many destinations, which might not be very financially attractive. So if you consider this NPV thing, this method of financing appraisal, which you do, all those projects will fail. But governments, they still do those projects because these are called public sector financing. And they are not only focused on the dollar value, which is being added to the shareholder wealth. There is no shareholder, there is no wealth concept there. In fact, we talk about some other social benefits into that. We say, okay, what is the benefit for this project, what is the benefit to the environment? What is the benefit to the society? What is the benefit, to the pollution or whatever. So adjusted present values are used there as well, because then we take plus minus, the impact, the benefits and the additional costs and the additional benefits, for other issues as well. So APV is a very, 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 how to say, fantastic way of seeing the things. I say, okay, in my NPV, I have my cost of debt, I have my cost of equity. It is for a business which has a portfolio of debt and equity, and that's there. We know that. But if we want to start from the very beginning, let's start from the scratch. We say, what if I invest in this project with 100% equity? What is the value? Now, this value I get 5 million, but I know that this 5 million is not the ultimate value because I do need to take debt for that. So then I take the debt. Okay, how much debt I have to take? Out of 5 million, I need to take 2 million of debt. So on that 2 million debt, how much interest I'm going to pay? And on that interest, how much tax benefit I will get? And then I need to discount that thing. And I will not discount it on my WACC, I will discount it on my cost of debt, which is relevant to that debt. So that makes more sense, okay? So this is actually the purpose of calculating APV. So now let's, I just discussed this thing because when we start doing the question, we might not be repeating it again because I already have explained you the purpose of APV. So we now start, reading the question and see what information is given. So it says that the financial management team of Tampem company is discussing how the company should appraise new investments. Not only one investment, but generally how they should be doing it. There is a difference of opinion between two managers. Manager A believes that net present value should be used as positive NPV. Our investments are quickly reflected in increase in the company's share price. This is true. It is also simpler to calculate than modified internal rate of return, MIRR. This is also true. And adjusted present values. This is also true. NPV is actually simpler and easier to calculate. So he is just telling the benefits of NPV. He is not telling the disadvantages or the drawbacks of NPV. He is only focusing on the benefits of using NPV, and these three are the benefits. Manager B, on the other hand, states that NPV is not good enough as it is only valid in potentially restrictive conditions and should be replaced by APV. Potentially restricted conditions. Now, what are those conditions? You should be using NPV for those projects which do not change your risk profile. So projects, they are similar, they are offering the similar risk. For example, you are a construction company and the new project is also for a construction company, for a construction project. So you are not changing your risk profile, you are not changing the nature of business, okay? But if you are a retail company and you are going into construction, now these are two different sectors offering two different risks, okay? So then NPV is not suitable. Number one. Number two, if the new project has a large size as compared to the size of the company, NPV is used actually, even if you are a retail business and you are going to construction, which is a different sector, you still can use NPV if you are a very big retail business and this is a very small construction project. So the risks, I know that in construction there are more risks, but it's such a small business. I mean, I've got a company worth of 1 billion and this is a 20 million construction project. Even if it is offering more risks, my overall risk profile will not be so seriously or significantly impacted because the project itself is so small as compared to the size of this business. But yes, if this is my retail business and this kind of construction project I'm going to do, then definitely my risk profile changes. Okay, so restrictive conditions and should be replaced by APV. I mean, if you ask me, should we use NPV or should we use APV? My answer to this thing is that you should be using NPV, but use it carefully. Use it carefully. For example, like I said that if you have a very big company and you are starting a new project, which is smaller, which might have a different risk profile, maybe more, maybe less, but the project itself is so small, you can go for NPV, no problem. Because this is in any case not going to change your, the risk profile. Similarly, the equity debt. If this company has an equity debt ratio of 60-40, and this project is also coming with 60-40, you can again go because your gearing ratio is not changing. Your gearing is not changing. Now, it is a small project. Even this small project is like 50-50, but still because it is so small, when it goes to the total, the impact is not bigger. But if it is a bigger project with a different gearing ratio, then NPV is not suitable. Okay, so these are the two things which we said restrictive conditions. So Tampem has produced estimates of relevant cash flows and other financial information associated with a new investment. These are shown below. So year 1, 2, 3, 4, you've got investment pre-tax operating cash flows, 1.25 million, 1.4 million, 1.6 million, 1.8 million. These are pre-tax and these are not discounted yet. Then they have given us some notes which are important to understand. Number one, investment will cost 5.4 million payable immediately, including, and this 5.4 million includes 600,000 for working capital and 400,000 for issue cost. It means 6 and 4. 1 million, 5.4 is total, 4.4 is your non-current asset, something like this, maybe plant and machinery, whatever. 600,000 you have kept it for working capital, 400,000 is for issue cost. Issue cost means you might be issuing some kind of debt or probably equity, I'm not sure, maybe debt, and for that it is the cost. 300,000 of issue cost is for equity and 100,000 for debt. Okay, so 300,000 for equity, 100,000 for debt. Issue costs are not tax allowable. Very important. You are not going to get benefit on this issue costs. Okay. And working capital, in any case, there is no tax benefit because you don't depreciate. So ultimately, it looks like that the depreciable amount is going to be 4.4 million. Okay. The investment will be financed 50% equity, 50% debt, which is believed to reflect its debt capacity, which means this is what the company can issue debt, which is 50% equity, 50% debt. Expected company gearing after the investment will change to 60% equity, 40% debt. You see your gearing is being changed. If your gearing is changed by this new project, NPV is actually you have to reconsider because your company gearing is changing. The investment equity beta is 1.5, which means that this investment is offering a risk higher than the market because market return beta is 1. The market return beta, which means the average return and the average risk. For average return, the average risk is 1. If there is risk is 1.5, beta is more than 1, then this project should bring returns more than the market, higher than the market. Okay. I will come back to this point in a while. Debt finance for the investment will be on 8% fixed rate bond. Okay. Tax allowable depreciation is 25%, corporate tax is 30%, risk-free rate is 4%, and market return is 10%. This is where I want to relate to. See, this is market return, which means an average return. And for that average return, the beta should be 1. Here, beta is always 1. If this for beta 1, return is 10%. If beta is 1.5, return should be more than 10%. Return should be more than 10% because this particular project is having or is giving you a risk level which is more than the average market. Market is having a risk factor of 1. Your project is having a risk factor of 1.5. It's a riskier project. Therefore, your return should also be more. Maybe 12%, maybe 13%. We need to calculate that, and we can calculate that by using that, CAPM model, etc. Okay. Number 9, it says that the after-tax realizable value of the investment after tax Realizable value of the investment as a continuing operation is estimated to be 1.5 million, including working capital. So it means that you will roll back and you will get back your investment in at the end of 4 years, 1.5 million, including the working capital. So you can consider the residual value because working capital comes back entirely. So 600,000 was working capital, 1.5 million I get back total. So it looks like that 900,000 for the project, 600,000 for working capital. I get 1.5 million. I can take out my cash at the end of 4 years. I will sell it to someone. Working capital may be assumed to be constant during the 4 years. Here, the life becomes easy because in many cases, you need to calculate working capital for different years because working capital requirement changes. In this case, it says it is constant, so it is helpful for us. Part A, requirement number A, calculate the expected NPV, MIRR, and APV. So all three we have to calculate. This is for 15 marks. And part B is discuss the validity of the views of two managers. Use your calculations in A to illustrate and support the discussion. This is for 10 marks. So we have read the question. We are almost ready to begin. Before I start producing the calculations, if you guys have, anyone has any question, you can ask. Okay, so for calculating your NPV, you know that we have got a very standard working table. We made it many times. We've got year 1, year 2, year 3, and year 4. Always need to pay attention that when the tax benefits will arrive in the same year of cash flows or in the later years. Sometimes they give you revenue. Here you write down revenue, then you subtract the fixed cost, you subtract the variable cost. In many cases, the revenue is increasing at some inflation rate. We don't have that case. They don't give us variable cost. They don't give us fixed cost. So it's pretty much simple actually for NPV calculation. So you have operational cash flows, which are in year 1, 1250 in million. I will write down here actually 3 zeros on the top so that we know that these numbers are in millions. So it is 1400, 1600, 1800. This is the same NPV calculation we have done 1,000,000 times. If not 1,000,000 times, at least we have done 500,000 times. Anyways, after this thing, what we need to do, we need to subtract the tax allowable depreciation, TAD, because this is the operational cash flow, and we need to subtract the depreciation, which we do not have here. So we need to make our TAD. So opening value, what you can do that you can say it in, in year 1. And so what are you going to get in year 1, year 2? How much of the, how much depreciation you can show. So we start with, this is important that here you should remember that your total investment value is 5.4 million. But within this 5.4, 400,000, 600,000 is working capital, 400,000 is issuing cost. So actually your depreciating assets are only 44 million. 4.4 million. So this is where I'm starting from. And there I get my, I think it is 25% reducing balance. Let me just make sure. Yeah, 25% I have it, okay? So 25% reducing balance if I have. So how much depreciation I'm going to show it here? It is 1,100. 1,100, I get a number 1.1 million depreciation will go into year 1. The second year, because it is reducing balance, so your second year it is 3.3 million, which is remaining. And then on this 3.3 million, you will take this number 25%. And then I copy paste it. And I can actually do copy paste here as well. No, this into 25. And then the last year it is this much. And so what I need to do now, I am going to take these depreciations here, and we will actually put it as a negative sign. We will put this thing as a negative sign because this is where we are decreasing the profit into this one, into -1, this into -1. I get this number here, depreciation to be shown in second year and in third year. And I come down to 464 into -1, okay? So this is my taxable profit now. This is our taxable profit. We just format these numbers a little bit better like this. So this is your taxable profit, which has come as 150 and so on. And here we need to add the tax, which is, I think, 30%, if I'm not wrong. 30%, okay? So you calculate your tax, how much is the tax there? And yeah, taxable profit and $150. So this is this into 0.3. And tax, because I'm giving a cash outflow, I put it like this. And then actually you now you need to find out, you can actually make a total or you can go without making a total. Okay, in any case, you can say, okay, find out what is the profit or cash flow after tax and then add back depreciation. This can be done. You can find a total like this and then add back this depreciation. We have done it many times before, okay? You can do like this. You can make a total of these two numbers. Okay, this is my taxable profit, 150. I pay tax 45. Let me just take these numbers like this, 45. So it is 105. And then I add back this depreciation because the cash is still with me. It's non-cash expense. You can make a total. I would rather prefer to not to make a total. I would say add back depreciation so that we don't have many columns there, or not many rows here. So I'll just add back these numbers and then I make a total here, okay? So that makes me 1205 here. I mean, these all calculations, I'm not explaining a lot because like I said that we have done them 500,000 times, okay? So this is what we have got here, operational cash flows. Then we also have some recoverable amount or residual value, whatever you may call it, residual value of the project, which comes here as 1.5 million. They told us before here that there is 1.5 million of cash which is coming in, right? Here it is given somewhere. Just want to see where it was given. Was it 1.5 million? I lost that amount.
So it's 0.9.
Huh?
So it's 9th point.
No, it is 1.5 because you get your working capital also you get back total. So you talk about total cash flow which you receive. 900 is from the non-current asset and the remaining you get from your working capital. Working capital also will roll back in, okay? And then you have your investment here, which is you need to take 500. So this is minus 5 million or 5.4 million, I can say total. It includes my issue costs as well. And this I say net cash flows. Actually, the real work will start now. So far, what I'm doing is nothing. So far, what I'm doing is nothing because actual task will start now. So add back depreciation. These are the numbers. And then you get this number here. And you take it down there, okay? So these are your net cash flows. And here, what you need to do, you need to find out your discount rate or discount factor, let's call it. And for calculating your discount factor, you need to go to your making your WACC. Okay, so you have to make your WACC now. Calculate your WACC, and based on WACC, we will find out. So if I found out WACC now, so WACC formula, we all know what is the formula for WACC. Let me write it down again. Equity divided by equity plus debt. You might have different variables used in your different books, multiplied by cost of equity. Then we say plus debt divided by equity plus debt. No need to explain this formula. Multiplied by cost of debt multiplied by 1 minus T, the tax benefit. Okay, so this is something we learned many years ago when we were doing F9, the basics, the VAT formula. So we need to find out here. So what is the KE and what is the debt? I know that my cost of debt is 8%. That is for sure. It is given in this here. This has no problem. I can spot it out here. Cost of debt is 8%. This is for sure. But how much is my cost of equity? That I don't know. Cost of equity I need to calculate because this project has a different risk factor. So if I consider so for calculating the cost of equity for KE, let's use CAPM, okay? Let's use CAPM. And CAPM says that cost of equity KE is equal to, you've got your RF, risk-free rate, plus beta multiplied by RM minus RF, okay? So market return minus risk-free return. So what is my now KE? It would be risk-free rate is given as 4%. You can write down 0.04 or you can write down 4%, whatever you wish to, plus your beta you need to calculate here. Beta for this particular project is given as 1.5. I have taken it from here. This particular project has a beta of 1.5 and multiplied by RM, which is given in the question as 10%. It is given below at 10% minus 4%. Okay. So if I just now put a sign equals to, it gives me 13%. You see that market return, on market, the average return is 10%. But this particular project, the shareholders or the equity holders, they expect 13% return. Why? Because the project has a higher risk profile. This project, because 10% is where beta value is 1. And if beta value is 1.5, the return, the expected return by the shareholders, by the equity providers has increased. Debt is always lower. Cost of debt is always low. So cost of equity is more. Cost of debt is low because debt holders do not take any risk. They have mortgages, they get fixed payments, etc. So I know my KD, I know my KE. I can actually now use this formula and we can fill in the numbers here. Okay. So I'll just put it. Okay, let's start putting the numbers. Now, in this particular project, the thing is that how do we know that how much is equity and how much is debt? They said that this project is going to be financed by equity and finance would be equal. Okay. It said that project investment will be financed 50% equity, 50% debt. This is what they have told you. But then they also tell you that this would be 60%, this would be 40%. After taking this project, your equity debt ratio, it might change. So then you need to consider that what is happening, that 60% of my, so equity is going to be 60% and debt is going to be 40%. You can assume any numbers actually. There are two ways of doing this thing. let's see that if I say equity is 60, debt is 40, so it is 60 by 100. Okay, I can call it 6 by 10. 6 by 10. Okay. 60 is, so it is like, I can write down like this. Okay. 6 is 6 plus 4. Okay. So equity 6, debt is 4, total is 10. So 6 divided by 6 plus 4. I can call it 6 by 10. Make it simple. Multiplied by cost of equity, which is 13%, plus debt is 4 divided by 10, multiplied by cost of debt, which is 8%, multiplied by 1 minus t. T is tax is 30%. So 1 minus t is 0.7. And this is numbers, I have just put them here. And if I calculate like this, it gives me in terms of percentages, it is 10%. So my WACC, which I have calculated for this project, is 10%. Okay, so it means that my discount rate is 10%. And for this 10%, I need to find out the discount factors here. So I know that my discount rate is 10%, and I need to find out, and this is, by the way, in year 0. And when you have in year 0, the discount factor is always 1. But for here, you need to calculate. How do you calculate? 1 divided by 1 plus interest rate, which is 1.1. I can call it 1.1. Okay. And I will say power 1. Power 1. I'll need to put equals to sign. Power 1. Okay. And if I see that, how does it look like? Yes, 10%, 0.9091. We remember these numbers. Okay. And now for the sake of simplicity, I will keep this number. Okay, I'll just take copy paste. I get these numbers, the discount rates. Now, by the way, I've explained this before as well. I am using formula for making this calculation. You should not be doing it in exam, because what happens that this is 0.9091. Okay. But if you see that because of Excel, it has many values. So there is a lot of difference in calculation. So what you should be doing, actually, you should be using your discount tables and find out the first 4 digits. So let me call it 0.9091, 0.826. Actually, sometimes you have 3, sometimes you have 4 values. So 8264, this is 0.7513. It looks like that I'm using the same number. I'm saying 0.6830, so I'm just removing 0.6830, but it is going to give a different result because now it has an absolute 4-digit value. There are no 5th, 6th, 7th, 8th digit. So always use 4 digits. Don't use the formulas here. So you've got present value. So I just multiply this number with this thing, and then I copy paste the formula. And then I find out my NPV, which is a sum total of all of these numbers. And that comes out to be a negative number. If you see that your NPV has come out to be a negative number, and let me put it like this, 329 million negative. So based on NPV method, this project should not be done. This was manager A who was suggesting to use NPV method. And if I consider the NPV method, this is 329,000 negative because there are 3 zeros on the top. So it is 329,000 negative NPV. Project should be abandoned based on NPV. But then the manager B comes in, and manager B says that we should be taking a different approach. Because what happened that we discounted these cash flows at 10%. We discounted these cash flows at 10%. And this 10%, it includes the cost of equity, cost of debt. What if such a project which is giving these cash flows, if this type of a project is taken up with 100% equity, we've got the money, we are doing it ourselves. And then we will take the impact of the debt benefit, because of course we know that we don't have the cash, but we assume for a while, just to begin the discussion, if we do it ourselves, what is the value of the project? Right now, the value of this project, actually, it incorporates this value. This is not the real value of the project itself. My friends, please understand. This is not the real value of the project itself. This is the value of the project, considering that there is some debt and there are some, the beta of the beta has gone up to 1.5, and that 1.5 beta has changed the cost of equity to 13%, and that cost of equity has ultimately resulted in changing my WACC. What if the project has no debt? Then there will be no then we will not have a 1.5 beta. And if we don't have 1.5 beta, our cost of equity would never go up to 13%, and our discount rate would not be 10%. So let's start thinking that because these numbers are very much debatable. Is it 1.5? Shouldn't it be 1.45? What if it goes to 1.55? What is the source of taking this number? You took it from a comparative company, but that comparative company might not be very much similar to you. That is the best possible estimate available in the market, but it's not exact, it's not accurate. It is just the best possible, but it's not accurate. So there are so many, how to say, debatable issues here. So I say, okay, you say the business has NPV of 3.2 million. My first answer is that NPV, this is the NPV of the project if you fund it with 50% or 60%, if you fund it with 50% debt or whatever, and if your gearing has gone to 60-40, and if the project beta is 1.5, and project beta depends on the gearing itself, because remember, the beta has two components: geared beta, ungeared beta, asset beta, equity beta. Because that beta which you are using 1.5, that beta 1.5, actually you have learned it before, that this beta 1.5, it is associated with two types of risks. One is the business risk itself, and the other one is your capital structure risk, which you call, the financial risk there as well. So I say, okay, let's remove this thing. The other one, the gearing risk, the equity and debt risk. Let's see if there is only the business risk, then how much it will be. I want to see that. And probably that is going to be a positive value. We don't know, but most probably it is going to be a better number than this 329, because 329, it includes the risks. And I want to see the real value of this particular project in the absence of any types of risks associated with taking the debts. I'm not taking the debt. If I do it with my own money, then what happens? Number one. And number two, another problem here is that you took this tax benefit, the tax shield which you, that interest shield which you got, interest and the tax shield which you got, you discounted it also, the impact also at 10%, whereas the cost of debt is only 8%. So that also I'm not agreeing. So in order to get rid of these two, abnormalities, let's start seeing how does the APV works. What is APV? What is adjusted present value? And how do we solve this issue? Adjusted present value. Are you people with me, or am I doing it for myself only? Yes, friends. Any questions so far? Okay, before we start doing APV, somebody asked a question, which I actually wanted to point out, but because it was not required in this scenario, so I just ignored it. But it is better to understand this thing. I mean, if you really want to do it better, see what happens. Let's understand the scenario. We got 5.4 million of total investment. Out of that, 600,000 goes to working capital, the cash. 400,000 is my expense, which is for issuing cost. I gave it to some banks, brokers, whatever. So my non-current assets are 4.4 million. And I started depreciating 4.4 million, okay? 4.4 million. And because it is on reducing balance method, so 25% goes 1.1 million in depreciation in year one. So in year two, my asset becomes 3.3 million. I depreciate 25%, 825,000. Then in year three, year four. Now, the book value at the end of the year four is 464 million. The book value end of year four is 464,000 because remaining you already have shown as a depreciation in your books here. You already got the tax benefit on that. These are the depreciation values. Now what happened? They told you that you will recover this thing at the end of the life for 1.5 million. It shows here that there is a value of 1.5 million. I actually was finding it difficult to track back. Where is 1.5 million given before?
It's number 9 point, sir.
Yeah, number 9. So number 9, it says that end of the year, the after-tax realizable value. It says after-tax realizable value of the investment as a continuing operation is estimated to be 1.5 million. So pay attention to this word after-tax. Now, what happens that in general situations, in usual circumstances, what you should do? Now, you know that your asset has a book value of 464,000. You are getting 1.5 million. Out of 1.5 million, issue cost were there. Issue cost you paid as expense. But it does include that working capital as well, because it said in the question in number 9 that it includes the working capital as well, including working capital. Okay. So if it is including working capital, so 1,500 minus the 600 working capital, I'm actually selling the asset for 900. The book value is 464. So there is actually a gain on disposal. You understand that there is a disposal gain, and that disposal gain should be attracted by 30% tax, which you call balancing allowance and balancing charge. If you were selling it at lower the value than 464, let's suppose you sell it for 300, you are making a loss, and against that loss you should get some tax benefit. In this case, an asset which is on your books 464, you are selling for 900. It means you charged more depreciation before. It means you got more benefit before, which you were not entitled. When you make a gain on disposal, you pay tax on that gain. So that 900, what I'm selling it for 900, and this is 464 in my books. So 900 minus 464, I'm making a gain of 436 multiplied by 30%. I should be paying 130,000 tax on that. 130,000 tax on that. So why do I pay tax? Number one, there are two ways of thinking. One way of thinking is it's a gain, I should pay tax. Another way of thinking is that this depreciation which you charged before and on which you got the benefits, you actually charged more depreciation before. Asset was not depreciated so much. So because you've got the benefits in the last years, now you have to return back that thing. You got more benefit. You should have depreciated it less. You should have shown less depreciation and you have taken less tax benefits. So two way of thinking. Number one, easy way of seeing is it's a gain, I should pay tax. But another way of seeing is I charged depreciation in past more. I got the tax benefits, which I did not deserve. So now I have to pay back this thing. So you always make the adjustment. Always you should see that how much is the book value, how much I'm selling. If I'm selling more, if I'm selling for more, I should pay further tax. And you should have here the additional tax thing in the last year. You should have shown here something, the tax thing in the last year. Or if you are selling at a loss, you make a gain on the tax. But why did we not do it here? Did we forget to do it? Did we forget to do it? Why we did not do it? This makes sense. This is absolutely something we should be doing in all scenarios. I mean, you are making a gain. You should be paying tax. Why you are not paying tax? Because the question says, it is after tax. You already have incorporated tax. So probably you are actually receiving 1.5 million. You actually sold it for 1.9, 1.8, whatever. You paid tax. After paying tax, this is the net amount. Understand? Did you get this thing? After tax realizable value, which means that you made a gain on that 436,000, and that gain resulted in some tax liability. So after paying the tax, the net amount is 1.5 million. If they have not given you this sentence, if they had not given you this word after tax, if they told you only that let's suppose I remove this word, and the sentence is the realizable value of the investment as a continuing operation is 1.5 million. If this had been the sentence, then I should have paid tax on that. What I would have done here, that 1.5 million, which I'm receiving as a positive cash flow, below that, I would say 436,000 times 36%, which made me 130.8, and I would subtract 130.8. I would say that I would receive this, but this much I will pay tax. So the net amount which I will get, the net amount will be 1369.2, something like this. Am I clear?
Yes, thank you.
Any further question? Okay. So now we need to do adjusted present value. And the concept is like the same thing. We will take the same NPV calculations. Our cash flows are not going to change in any case. So we are not going to change the cash flows. So this is the same table which you will have. Yeah, a few things will change, and those I will explain you. So I'll just copy paste this thing here. And what will happen that I just want to take, instead of making this all of this calculation, why not take this final cash flow? Because this is the final cash flow 1205. So I take this final cash flow. Because rest of the conditions of the project, they remain same. So I take this one 1205, and I control C and control V. But in this case, for my investment, so I'll say my final cash flow. So remember, we said that in APV, I mean, it's the same NPV thing. Project are same, cash flows are not changing. My discount rate will change, because before I discounted the project with my WACC. And this time I will say I'm not going to use WACC, because I'm assuming that in adjusted present value, I start with the idea that this is an equity finance project, and it should not have debt and betas which are associated, with the risk. So, but one thing is there, here I put 5.4 million, and that 5.4 million, it includes 400,000 of, remember, 400,000 was your, how to say, issue cost. So let me just break it down. You had 4.4 million of assets, 600,000 of working capital, 400,000 of your issue costs. So if you assume that I have got the cash, I'm not going to issue anything, so then the value of the project investment is only 5 million. Okay. So in case of APV, I'm not going to take this 5.4 million. I will take 5 million only. Okay. That makes sense. So that 5 million, I will put my investment project as here minus 5 million. This 5 million includes 4.4 million, this non-current asset, 4.4, this one, plus 600,000 working capital. And then I need my discount factor here, okay? So And this time there will be a change in the discount factor. I say that, okay, I need to find out, I'm not going to do it on VAT. I want to do it on KE, the cost of equity, the shareholders required return. I will discount it with discount factor, which I assume is going to be my KE. Now, how to find the KE thing? The KE formula, which we had before for our let me just put it a little below. We said that we have CAPM we are going to use again. And CAPM KE is equal to RF equals to RF. Where is my F? Plus beta times RM minus RF. The same formula we used before. But this time we are not going to use beta this one, because before we use this beta 1.5, we used a beta of 1.5, which is called a geared beta. This is investment equity beta. Equity beta, this is BE. Remember, equity beta means the risk which is faced by the shareholders. Equity shareholders, we call it BE. And shareholders, they face two types of risks. One risk is due to the nature of the business, which is construction or whatever. And the second risk is the risk which arises because of the presence of debt. So BE is always a bigger value. And there is another beta, which is called asset beta. Asset beta is only has one type of risk, which is the business risk. This has two risks inside, the business risk and the risk as a result of the gearing, the result of the presence of debt. So this is called geared beta. We call it geared beta because it has gearing impact inside. This BA, we call it ungeared beta. And sometime in US term, you call it unlevered beta. This is leverage, which means debt is there. This is unlevered, there is no debt. So what we are given 1.5 is the equity beta, which includes two risks. And I want to eliminate one risk. Which risk? I say I'm doing it with my own money. There is no debt, so there is no risk. So if the same project, if there is no risk, if I'm removing the debt, then what should be my asset beta? What is the risk associated with this nature of business? This is a construction thing. So what is the risk of construction business itself only? Forget about the risks for the debt, just remove it. So what we need to do, we need to ungear it. We call it ungearing. Okay, and ungearing formula would be the formula for ungearing. What we need to do here, we say, let's calculate our ungeared beta, which means that I want to calculate my beta asset beta. And the formula here for my asset beta is, if you remember, equity beta multiplied by equity divided by equity plus debt, equity divided by equity with debt into 1 minus T. I just make sure that I don't I need to put correct brackets. I think here I need to have one bracket more in the formula, ED. Yeah, I think like this. So if I just start putting the values here now, so my beta asset would be equity beta 1.5 multiplied by, now how much is equity, how much is debt? They told you that if you do this project with the debt, you are going to take 50-50, 50 equity, 50 debt, which means 1-to-1 ratio. So I will assume here the number as 1. What has happened? My 1 divided by 1 plus 1 into 1 minus T is 0.7. And I put a bracket, okay? Something like this, if I'm not making a mistake in putting. Do I need to put a bracket on the top? Actually, not really. This bracket on the top is not needed, I think. Yeah, this is 0.7, and I need to put one more bracket here. Yeah, so there is one bracket in the end as well. So now my beta asset is 0.88. Now, if I just take it to 2 decimal places, it is 0.883, okay, 882, you can call it. See, there's a big difference now. You had a beta before 1.5. They said that, you see, this project is a risky project. It gives a 1.5 beta, and therefore your shareholders, they were requesting you a return of 13%. 13% they were asking me. Because this 13% return is there to cover their, the risks from that particular, they are covering their risk-free rate. They are covering their risks. They want 4% risk-free rate, plus a certain premium for this particular nature of business, plus a certain premium for having the debt in the project. But if I remove the debt on the project, risk-free rate is 4%, and they say we are happy with a lower thing because they are only getting a beta of 0.882. So if I put this value now in my CAPM here, what I get here now, that KE will be risk-free rate is 4%, plus the beta I'm taking 0.882 multiplied by RM, which is 10%, minus RF, which is 4%. So if I take now this number, shareholders, equity shareholders, they are happy with 9.29% as well. Before they were asking 13%. And their expectation of 13% was because of that additional debt into that thing. If there is no debt, 9.29%. I can assume it as 9% because in exam, you will be given tables for 8%, 9%, 10%. So let's assume it to be 9% and then find out the value. So we go here now and we discount it. The discount rate now is going to be 9%. So the same cash flows, year 0 will be 1, and here it would be 1 divided by 1 plus 0.09. And I would say power 1. Okay, so
So the bracket is not correct, sir. Yeah. And there should be a bracket after the divide rule.
1.09 power 1. So these are going to be my discount rates. If I take them to 3 decimal places, and again, like I said, I'm using Excel because I don't have a table in front of me, but when you are doing it, you should be doing it with the tables to get accurate values. So because in exam, they use the solutions for ACCA, they are not linked with Excel, they are linked with the tables. So let me call it 0.917, and then I will call it 0.842. I call it 0.772, and I call it 0.708, 0.708. And now I see that how much it makes me. Present value is and I've got my APV here. Which is a sum total of these numbers. That is 199,000. Now you see this time it has become positive number. So we started with NPV. NPV was negative 399,000 or something. And my APV is positive. So manager A says, don't do the project. Manager B says, project is giving 199,000 positive. Let's do the project. That looks good. That looks good. You see, the result has changed, but the discussion has not stopped. because manager A said NPV is negative, I'm not doing the project. Manager B says that NPV is positive, I'm doing the project, it's not negative. But then the question arises, do you think you will get 199,000? In reality, the answer is no, because you don't have money. You don't have money. You need to issue the, what is going to happen that you have to include the debt inside. Right now, you said that I assume that if I do it with my own money, I assumed if I do it my own self, but you don't have cash. So what you need to do now, you need to make adjustment to that thing. So you will say that, you need to find out that what are the other costs related to AP related costs and benefits. APV valuation. So I say my basic APV is 199,000, but I don't have money and I have to, issue the bonds, issue the debt. So I've got my issue costs here. Do you have cash? No, I don't have. You assume that if I had cash, this project would have given this, but you don't have cash. So let's start with here. This is the project, 100% without debt. But then you say, if I issue the debt, what is the cost? That is 400,000. 400,000 is the cost of issuing the debt. So let's adjust this thing. But then when you will issue the debt, you will get some tax benefit as well. So you will get your tax shield. You say, okay, so manager, you were very happy. You are manager B. You said, see, I've got 199 from this project. And manager A will say, wait a minute, you don't have money. You have to raise the debt and equity. For that, you need to pay 400. See, you are in loss again. 199 minus 400, you are in loss again. And then you say, no, wait a minute, because when I issue debt, I will get my tax shield. So how much is the total investment required? 5.4 million. I am going to issue 50% of that is going to be the debt, okay? Which makes me 2.7 million. On 2.7 million, what is the cost of debt? Cost of debt is 8%. 8% is your cost of debt. And what is your tax shield? Tax shield is 30% of that. So it means that you are going to get this much of tax shield, 64.8 thousand. 64,000 you are going to get, because I'm assuming 3 zeros on the top. So 64,000, this is actually 64,000 you are going to get the tax benefit. And this tax benefit, you will get it in 4 years, not in 1 year. You are going to get it throughout the life. So you need to multiply it with the annuity factor, okay? So what is the annuity factor for 8% at 4 years? So let's multiply that thing. So if I find out the annuity factor for 8%, for that again, you will use your annuity table. I'm using my, 1 divided by 1 plus 8%. And I'll take power 1. And this is my year 2, year 3, year 4. I'm just quickly calculating myself, okay? And I'll take this number as power 8%. 8% is F4. And this is this. You know how do I'm making my annuity table actually. You will use it from the book. I'm just quickly making it myself. So it is 2.70. 8%, 0.92, and this one, and this one, and I'm adding this one with 8% here, 1, 2, 3, 4, 2.70, whatever it is. I'll multiply this thing, 2.7064. Please, I just did it quickly myself. You should be taking it from your, your table, okay? So it looks very small actually number. I don't think it should be 2.7%. It does not look very good because 4-year annuity factor can't be 2.7.
According to the table,
How much it is in the table? Okay, 3.312. So let's ignore it for a moment because we are doing it quickly. You said the value from the table is 3.32, right? Please speak. Let me see. 3.31.
3.312.
Okay, so 3.312. So 214,000. So this is my tax shield benefit, which is 214. And now when we make a total, so this is 14 million. So my APV. So APV still is telling you 14,000. So APV still, because 3 zeros on the top. So there are 3 zeros on the top. So if you see that with the APV method, you actually have got a positive NPV of 14,000, even after considering your issue cost, even after considering your this tax benefit. So whatever things were mixed up in the NPV method, because NPV method, like I discussed in the very beginning, that NPV method was discounting your tax benefit at WACC 10%, which was not true. You should be taking tax benefit at the tax cost of debt. The second thing was that NPV method was not assuming, it was taking both of the risks. So we ungeared it and we said, okay, let's start from the beginning. Think like if we do the project ourselves, what is the value? And then if we take some further debt, maybe we don't take debt. If you don't take debt, just don't have issue cost. And then you have got tax shield benefit there. So this is your final APV value of 14,000. Now, there is one more part to this question, which is about MIRR, right? The last thing, I mean, they asked 3 things to calculate in the question. They asked us to calculate NPV, APV, and IRR. Where is the question? MIRR. Okay, so what is MIRR? MIRR is very simple, very easy. What happens? That's very interesting, actually, and that takes discussion a little longer. In NPV method, we assume, many times what will happen that you will calculate an NPV positive 1 million, positive 2 million, and we say NPV, it actually depends on these cash flows. If our revenues and costs are more or less, cash flow will change, NPV will change. So these are the problems with my estimates, because these are the numbers which I estimated. And if any of these numbers does not realize, then NPV will not be achieved. But my question is, what if I achieve all of these numbers as it is? If I find out, if I make sure that my revenue is exactly like this, my costs are exactly like this, and I achieve all of these numbers dot to dot, do I still find out the same NPV as a result? The answer is that in many cases, no. Even if you achieve all the cash inflows and outflows as you forecast, still your NPV, end of the day, is not, you are not getting what you expected. The reason is that NPV, it assumes that all the free cash flows, whichever you will make, like end of year 1, you had a cash flow of 1.2 million. Year 2, you had a cash flow of 1.228 million. These cash flows will be reinvested. These cash flows will be reinvested at your WACC. Remember that cost of capital, weighted average cost of capital, which was 10%. These will be reinvested again. So if the cash is lying there, it is not being reinvested, you are not going to get the end result. And this is a very difficult condition. How come is it possible that end of the year I get some cash and next day, early morning, I wake up, I find out an opportunity and I invest the cash again at the same rate? My cash is lying idle many times. So therefore, because you cannot find so many opportunities at the same rate, you do not end up getting the same NPV. And if I have to prove this thing, which I'm saying, remember when I was teaching Not here, but let's suppose that we were doing it in FM. Remember, we said that if $1,000 is invested for 3 years at 10%, how much it will be at the end of 3 years. So how do we do that? We say that, okay, year one, 1,000, the profit in year one is this one. And what happens that end of the year, you get 1,100. In next year, you have 1,100 and the profit on this thing is 10% and the total is this one. And then you said that, okay, this is the total. And in next year, your return will be 10% and end of the day, you make 1,331. So you assume that your $1,000 will be converted into 1,331 if they are invested at 10% for a period of 3 years. What are we doing? Whatever we generated $100 end of the year, the very next morning they were invested and your 1,100, it started generating profit the same day, and therefore you get 110 in next year. And you get 100, and whatever you made in year two, it is added, and the next morning it started earning again 10%, because your formula here, the present value and the future value formula, that future value is equal to present value into 1 plus I power n. Remember that relationship. So this is the future value 1,331. It is equal to present value 1,000 into 1 plus 10%. And power 3. That's how they become equal. But in reality, you are not able to invest the money at WACC at 10%. So this is one inherent problem of NPV. Now, why are we talking about it? We are talking about MIRR. I mean, we started discussion with MIRR. Why are we talking about this? Because MIRR is modified internal rate of return. It is actually something with IRR. It has got to do something with IRR. And IRR also has the same problem. So just like NPV says, these surplus funds should be invested at your WACC. And you said, no, it's very difficult to find 10% WACC. IRR says your funds should also be invested. IRR also comes with the same claim that you must invest your funds. But IRR makes life even difficult for you, because it says that the funds should not be invested at WACC 10%. These should be invested at the IRR, internal rate of return, which is usually higher than your WACC. If you've got a WACC of 10%, your IRR always is more. That's why you are doing the project. Why do you do the project? Because your IRR is higher than your required rate of return. That's why you invest. So it is possible that my WACC is 10%, but my IRR is 14%. And IRR says invest funds are at 14%. Now, I was not able to find an opportunity for 10%. How can I find an opportunity for 14%? That makes life very difficult. So then we get to the point we say, okay, no, let's define it for MIRR, modified internal rate of return. So we are not investing it at how to say 14% or IRR rate. We will invest it at our WACC rate. Okay, so this is the concept of modified internal rate of return. Now, what do we have here? We've got a formula for MIRR here. This is. Let me just drag it, because this formula, I just want to explain you the formula and then move on. Okay, so this is our second part of the question, third part or second part, whatever you may call it, find out the MIRR. Now, the formula itself, it says that PVR over PVI. In different books, these names, I mean, these are variables, these are different, okay? And you can use any name. You can call it Y over X, whatever you may think. But then you define what is Y and what is X, okay? So you give them any name. So present value of R or present value of I. So present value of R is return, PV of return phase, PV of return phase. PV of return phase means that whatever cash flows you are generating, these cash flows, let me say, this is your return phase. Present value of these cash flows. So this is the present value. So actually, this is the return phase. And this is the present value of the return phase. So find out what are you going to get cash flows in year 1, year 2, year 3, year 4, and you divide it with your investment. How much was your investment? So PVI divided by PVI. Divided by PVI. Oh, this is my PVI, which is your present value of investment phase, which is 5.4 million, which is 5.4 million. So if I just want to find out, let me just see here, what is my PVI, okay? And PVR, and let me see what is my PVI. PVI is my 5.4 million. I'm going back to the original one, okay? I'm not take this number from APV, because in APV we ignored 400,000 issue cost. Actually, you do have issue cost. So this is also added to 5 million, 5 million plus this, okay? So this is here. And then I need to find out these cash flows, the sum total of present value of these cash flows. It is 5071. So I got two numbers. It says that 545071 divided by 5400, and then you multiply it with 1 plus RE. RE is your WACC minus 1. So if I have to write down, I will say 5070. I'll say 5071 divided by 5400. Multiply it with, and actually there is a power function, power 1 over n. It says 1 over n, which means 1 by 4. Making it simple, 1 by 4, I can call it 0.25. Multiply it with 1 plus RE, which means 1 plus 0.1. RE is your WACC, okay, is your WACC. And you say minus 1. This is the formula. And that gives me something like 8.28%. This is my MIRR. Okay, so that's pretty simple. If you've got the formula, you just need to put the numbers. You need to understand what you are dividing with what. Okay, so I mean, this is all the cash flows which I receive, the present value of those, divide it with the present value of my investment, take the life of the project as power 1 by n, and then multiply it with 1 plus KE, 1 plus WACC, and minus 1. Now, it's simple. There's nothing more I should be explaining. I explained you the concept. What is MIRR? And why do we do it? And I've shown you how do we do it. The only thing which is in my mind, what is this difficult formula for? Where did they come up with this thing? So what they are coming up with this thing is, I understand that the present value of my cash flow is only 5071. Whereas I'm making an investment of 5400, right? So I'm making a loss actually. Remember, NPV was negative. In this particular, when you took 5071, your NPV was 399 or 299,000 negative. So this is what it shows, that you invest 54 today and you get 5071. So this is like 5071 over 5400. It's just like I'm making $8 over $10. It is just like I'm making, $100 over an investment of $110. So this is a relationship first. Now, but the question is that, is this loss compounded in? So I know that there is a loss. For example, if I tell you that you make 6,000 over an investment of 5,000, so you say I make 5,000, I make $1,000 profit. But do you make it? But because it is expressed in terms of percentage, so my question is that you invest 5,000, you earn 6,000 over a period of 4 years, but do you make it in 1 year? You will say, no, I'm not making it 1 year. Actually, I'm making it over a period of 4 years. So I take 1 by 4. So here, there is a loss, which I'm going to make, whatever, or gain, but I take it 1 by 4. So that because I convert it into year 1. Remember, when you are making inflation of 2 years, if I say in year 1, inflation is 5%, in year 2, it is 5%, in year 3, it is 5%. So you say 1.05 inflation power 3 because you are compounding number of periods. So what you get the number here, this is a sum total of 3 years of inflation. What you will get here, you probably are getting here 1.22. And this 1.22 represents a growth of 3 years. So if I have a number, this number, which is a result of 4 years, and I want to see what is my average per year gain or loss. What is my gain or loss per year? So that's why I take 1 by 4. Understand? Not 4, but 1 by 4. 4 I will take if I have to calculate for 4 years. But if I've been given a number of 4 years and I want to convert it for 1 period, I take 1 by 4. So this I understand. This is my gain. This is my cash inflow. This is outflow. And 1 by n, I'm converting for 1 period. Then what is 1 plus RE? 1 plus RE, because when I was getting these numbers, I discounted them with 1 plus 1 cost of capital. This is how you were discounting. How did you get your discount factor? 1 divided by 1 plus I. This was discounting. So this number which you used, you actually divided it with the discount rate. Now I'm reversing it back because I'm talking about 1 period. There is no present value concept anymore needed. So I multiply it with this one. And what is this minus 1? This is to find out the percentage. This is to find out the percentage. What does that mean? Because if you don't subtract it from 1, you will get an answer something like 108.28. Remember nominal rate, real rate, we always subtract with 1. Percentages and the growth when we calculate, this is not something new. Subtracting 1, you understand, any growth you subtract in the end 1, so that you get a percentage of 8.28 because you have added 1 here. While calculating the growth, you have added 1 here. So you subtract it. Let's suppose if I just put the numbers. So if I just say that, okay, I've got 5071 divided by 5400. This is not required actually for the sake of this lesson. We are just discussing so that we understand. So understand, while investing in this project, I'm only getting 93% return back because I'm investing 54 and I'm getting 55. This is actually how we think about business and projects in real life. When you have to explain to your managers, when you have to take business decisions, you think in this way. So this is not academic thing. This is something more of a real life thing. Oh, I'm putting 54 and I'm getting 5071. It means I'm getting only 93%. But that 93% actually is over a period of 4 years. So what is annual impact? So for taking annual impact, I take power 0.25. So annual impact is 98%. And if this is 98% and I then multiply it with 1.1, which is my discount factor 1 plus RE, so that gives me actually 1.08. 1.08 is the total. And if I subtract from here 1, so, minus 1. So minus 1, I'm just subtracting. So net is, I have to put a sign here, this plus this. So it is 8.3%. 8.3% is my MIRR. So this project is actually giving 8.28%. Remember, when we said NPV, we said don't do it because it is 329,000 negative. And if I see IRR or even MIRR, it is 8.28%. It is less than the WACC. Where is your WACC? Your WACC was 8%. Your cost of capital was here somewhere 10%. 10% means that you have to pay something to the providers of debt and you have to give something to the providers of equity. And the average of that return, which you give to equity, because people are knocking your door. Equity providers said, I gave you 2.7 million, give me my 13%. Debt providers said, I give you my 2.7 million, give me 8%. On average, I have to pay out 10%. And the project is bringing only 8.8%. Remember, IRR is the real rate of return, what the project is bringing in. And this is the reason why NPV is coming negative. because the project is actually not generating wealth, it is actually exhausting wealth. You are earning 8.28% and you are giving away 10%. So every year, 1.62 or 68%, you are losing the money on this particular investment. So this is your, the scene for MIRR. So I think that's all for this question. It was a very short question, but we spent a lot of time. It is almost like 1 hour and 40 minutes. Let's stop it here. Any questions if you have, you can ask.